Hello viewers, welcome to my channel. I am Hasham. So now I am going to start the next problem number 8. Already 7 main problems I have completed on irrecoverable debt. So if you are continuously watching the successive videos, now you are in a better position to understand, to solve the problem on irrecoverable debt. So if you want the complete command, don't skip the first and second video. In the first video, I've explained the meaning of the term irrecoverable debt, then why it is calculated, what is the effect of irrecoverable debt and allowance for irrecoverable debt on the financial statements. All these things I've explained, and already 7 problems. Now I'm going to start the 8th problem. Before starting the problem, I expect my viewers to have a printout of the problems which are given in the link under my description. So before watching the video, always keep ready the printout of the problems. Take a screenshot of the solutions of these problems, then I'll explain each and every point of the problem. Come on, see the 8th one. 8th problem. On 1st January 2017, Chan's allowance for irrecoverable debt was 650. On 31st December 2017, the beginning of the year 1st Jan, end of the year 31st December 2017, he increased the allowance to 900. So beginning of the year allowance was 650 and end of the year allowance is 900. Increase in allowance. Prepare the allowance for irrecoverable debt account for the year ended 31st December 2017. Balance the account on 31st December 2017 and bring down the balance to 1st Jan 2018. So first question, you are required to prepare the allowance for irrecoverable debt. Chan. Allowance or provision for irrecoverable debt. Debit, credit, date details dollar, date details dollar. Now beginning balance. Balance brought down 650. This is the opening balance. Then we have to see whether there is increase or decrease. There is increase because end of the year 900. When there is increase, the entry will be income statement account debit, income statement debit, allowance for irrecoverable account credit. If there is increase. So here we should write on income statement. How much increased? 900 minus 650. 250 increased. 250 increased on the credit side. Take the total 650 plus 250, 900. Take the total 900 in both the columns. Then balance carried down. Balance carried down 900, 31st December 2017. This is the closing. Now carried down is on debit side. So brought down will be on the credit side. Balance brought down 900. Next year starts. 1st Jan 2018. That's all. First question completed. Prepared the provision for irrecoverable debt account. Next, B question. State the section of the statement of financial position where closing balance of the allowance for irrecoverable debt is shown. The closing balance of irrecoverable debt is 900. And this closing balance of 900 will be deducted from trade receivables under current assets. Under current assets in the statement of financial position. So it is asking you where it will be shown. So my answer is it will be shown under current assets. And this will be deducted from trade receivables. The closing balance of provision for irrecoverable debt will be deducted from trade receivable. On asset side under the current assets. That's all. B question completed. Now C question. Explain with reference to the accounting concept why it may be necessary to make the allowance for irrecoverable debt. The accounting concept prudence says that the accounts should show true and fair view. The income should not be overstated and financial position, the assets should not be overstated. So to avoid the overstating of income, we must make the allowance for irrecoverable debt. The prudence concept says the income should not be overstated. That's why we have to make the allowance for irrecoverable debt. So accounting concept which make necessary to make the provision for irrecoverable debt is prudence. Explanation. By not overstating the value of receivables. If we do not make the allowance for irrecoverable debt, then what will happen? The trade receivables will be overstated. The trade receivables will be overstated. So not to overstate the trade receivable, we have to make the allowance for irrecoverable debt. That's it. To show a true and fair view of the state of affairs. That's all. This is the end of problem number 8. Now I am moving on to problem number 9. Here we have A, B, C, D, 4 different questions. First, A bit. Explain the difference between irrecoverable debt and allowance for irrecoverable debt. Very frequently in examination this will be asked. Difference between irrecoverable debt and allowance for irrecoverable debt. Irrecoverable debt is a debt which is completely bad debt. There is no certainty of recovering the amount. When the business realizes, observes, thus we cannot be able to recover the amount, it is called irrecoverable. Completely irrecoverable. But sometimes the business will make an estimate. That means the business is not sure that we may receive or we may not receive the amount. There we will make an estimate, an allowance or a provision for irrecoverable debt. So here the answer, difference between irrecoverable and allowance for irrecoverable. When an irrecoverable debt is written off, there is reasonable certainty that the specific customer is not at all going to pay. When we write off irrecoverable debt, it means there is certainty that the credit customer is not at all going to pay the amount. The income statement is charged with the irrecoverable debt and the amount is taken off from the trade receivable ledger control account. For example, the business has to receive some $100 from Mr. X. The business realized that we will never recover because Mr. X has become insolvent, bankrupt, or he died. Then there is no possibility of any recovery of that amount. We will remove the name of Mr. X from trade receivables and we charge this irrecoverable debt to income statement as a loss. Then allowance for irrecoverable debt is made when there is some doubt that the total value of the trade receivable will be collected. If there is doubt that the receivables may be collected, for example, the total receivables are 100,000, 1 lakh, 100,000. Now the business says that according to our experience, we will not recover complete 100,000. We'll make a provision of 5%. Out of 100,000, 5% we will lose, we will not receive. That is an allowance, that's an estimate. Then the change in the allowance is charged to income statement through adjustment account. Now we compare the allowance at the beginning, allowance at the end. Whatever change in allowance will occur, that change we charge it to income statement. Through the total allowance is deducted from receivables in the statement of financial position. The allowance for irrecoverable debt at the end of the year will be deducted from trade receivables. Next, B point. State which accounting concept is being applied when creating an allowance for irrecoverable debt. Which accounting principle? We already know so many times we have applied. Prudence is the accounting concept which is applied when we provide for irrecoverable debt. Next, C. On 1st July 2016, Kyao was advised that Mayo, a customer, had ceased trading. This Kyo is the businessman. He is having one customer by name Mayo, and the Mayo has ceased his trading business, owing by them $580. That means Kyo has to receive $580 from Mayo. $580 are due from Mayo. Kyo decides to write off as irrecoverable debt. Kyo thinks that we cannot be able to get the money from Mayo. He has ceased his trading business. So Kyo has decided to write off it as irrecoverable debt. Prepare the journal entry to record this write-off. A narrative is not required. Simply it is asking you to pass the journal entry, which account debited, which account credited. Remember, whenever we are writing off irrecoverable debt should be debited and the customer should be credited. Here customer is Mao. So the journal entry will be irrecoverable debt debit $580. Mayo account credit $580. This is the journal entry. So irrecoverable debt debit $580, Mayo account credit $580. This is the entry for writing off of irrecoverable debt. Last question, debit. On 31st August 2016, Kayo receives a check of $275 from Mayo in payment of the debt that had been written off on 1st July 2016. Already Kayo has written off that amount, but later on Mayo has paid that amount. That is called irrecoverable debt recovered. Irrecoverable debt recovered. Already irrecoverable debt was written off. Now that customer has paid the amount. So Mayo has paid only $275. Now $275 has been received by Kayo, right? Then prepare the bad debts recovered account to record this transaction. Show the transfer to the financial statements at the end of 31st December 2016. Now we have to prepare the account of irrecoverable debt recovered. So we will prepare the account of Mayo. So Mayo has paid $275. Entry will be bank account debit, Mayo account credit. So Mayo account is credited bank $275. Now this $275 received from Mayo will be transferred to income statement. So debit side income statement $275. That's all. So this is the end of problem number 9. Now I am coming to problem number 10. Complete the table by indicating with a tick in which section of the financial statements each cost would be shown. So here options are given: expenses, income, current assets, current liability. Items are given. I am showing this in the table as it is, whatever is given in the problem. So item, expenses, incomes, current asset, current liability. So every item we have to decide the item will appear where, whether it will appear in expenses or income or current asset or current liability. Now we have to decide. First of all, irrecoverable debt. Irrecoverable debt is a loss, is an expense. Irrecoverable debt is an expense. So just to put a tick mark in expense. Irrecoverable debt is an expense. Secondly, allowance for irrecoverable debt. Allowance for irrecoverable debt will be deducted from current asset. In current asset, already I have explained you here, somewhere here. The closing balance of provision for irrecoverable debt will be deducted from trade receivable from under the current assets. The allowance for irrecoverable debt will be deducted from trade receivable under current asset. So under current asset, I'll write a tick mark. Now, allowance for irrecoverable debt decrease at the end of the year. At the end of the year, allowance for irrecoverable debt has decreased. So it will be added to the income. It will be added to gross profit. Already in theory video I have explained. We compare the opening allowance with the closing allowance. If the closing allowance are less, decreased, then whatever it is decreased, that will be added to gross profit or income. So allowance for irrecoverable debt decrease will be taken in income. Similarly, allowance for irrecoverable debt increase. We compare the allowance from opening and closing. If the closing allowance is more than the opening, in other words, increase in allowance will be taken under expenses in the income statement. It will be taken in the expenses. So this allowance for increase, irrecoverable increase will be taken in expense. So from this table what we have learnt, that irrecoverable debt is an expense. It will be taken in income statement under expenses. Allowance for irrecoverable debt, it will be deducted from trade receivable in current asset, under current asset. Allowance for irrecoverable debt decrease. If the current allowance for irrecoverable decrease, it will be added to income. If the allowance for irrecoverable debt increased, whatever is increased, that will be taken under expenses. That's it. This is the 10th problem. Now 11th one. John maintains an allowance for irrecoverable debt at 5% of trade receivable. The balance of the allowance on 1st May 2019 was $3,122. $3,122 is the opening allowance for irrecoverable debt. On 30th April 2020, the year begins on 1st May 2019, year ends on 30th April 2020. The balance of John's trade receivable ledger control account was $58,200, of which $1,600 was irrecoverable. At the end of the year, trade receivables are $58,200. And in this $58,200, $1,600 are irrecoverable. So we deduct $1,600. Prepare the journal entry to write off the irrecoverable debt. Already we have seen so many times the entry for irrecoverable debt. Irrecoverable debt account debit, and the credit should be given to trade receivable. And a narrative is required, narration is required. So first of all, entry, journal entry. So irrecoverable debt 1600 are irrecoverable. Irrecoverable debt 1600, trade receivables ledger control account credited 1600. This is a normal entry for writing of irrecoverable debt. Being the writing of irrecoverable debt. That's all. A bit completed. Second, B bit, calculate the balance of allowance for irrecoverable debt at the 1st May 2020. And at the end of the year, how much is the allowance for irrecoverable debt? First of all, from the total trade receivable, deduct irrecoverable debt. On the remaining balance, calculate the allowance. So how to calculate? Trade receivables ledger control account on 30th April 2020 is 58,200. Total trade receivable ledger control account. From this we deduct irrecoverable debt. Irrecoverable debt 1600, deduct 56,600 is the trade receivable. On this trade receivable we calculate allowance at the rate of 4%, at the rate of 5%. It is given in the problem. 5% means 5 by 100. So 56,600 into 5 by 100, $2,830. So $2,830 is the allowance for irrecoverable debt at the end of the year. That's it. The 12th problem, 11th problem I have completed. Now 12th problem. Wang maintains an allowance for irrecoverable debt at 4% of trade receivable. The balance of the allowance on 1st November 2018 was $965. The beginning of the year allowance was $965. At 31st October 2019, end of the year, the balance of Wang's trade receivable ledger control account was $23,620, of which $170 was irrecoverable. So this 170 will be deducted from 23,620. Now what it is asking? Calculate the balance on the allowance for irrecoverable debt account on 31st October 2019. That means closing. Closing allowance we have to calculate. Opening allowance is given $965. Closing allowance. So we take the trade receivable. From trade receivable deduct irrecoverable debt, just like the previous problem. Deduct the irrecoverable debt. The balance remaining, on that we calculate allowance for irrecoverable debt. So trade receivables ledger control account on 31st October 2019, 23,620 given. And irrecoverable debt is given $170. Deduct 170, 23,450 is the trade receivable. On this amount, allowance for irrecoverable debt at the rate of 4%. 4% is given. So 23,450 into 4 by 100, $938. First question it is asking you to calculate the allowance, and we have calculated the allowance $938 at the end of the year. B point. Prepare the allowance for irrecoverable debt account for the year ended 31st October 2019, showing the transfer to the income statement. Whatever difference is there in allowance from opening to closing, the difference in allowance will be transferred to income statement. Balance the account at this date and bring down the balance. Now see here. Beginning of the year allowance was 965 and end of the year allowance is 938. That means allowance has decreased. Allowance has decreased. Now the entry for decrease in allowance is allowance for irrecoverable debit and income statement credit. Allowance for irrecoverable debit and income statement credit. So debit side you should take income statement because it is decreased. In the previous problem there was increase. That's why we have taken on the credit side. You can see here. When there is increase in allowance, credit side. When there is decrease in the allowance, debit side. So in this problem itself you can make the comparison. Here income statement credit side, here income statement debit side. Here there is increase in allowance at the end of the year. Here there is decrease in allowance at the end of the year. How much decrease? 965 minus 938, 27. $27 decrease to income statement. End of the year, 2019, October 31st. Now take the total on the debit side, 965. Here also 965. Oh, sorry, 965 is the total here. 965 is the total. So here the balancing figure is 938. 965 minus 27. We'll get 938 is the closing balance. Now this will be carried down, brought down. 2019 November 1st, balance brought down 938. That's it. So we have completed 12 problems on this topic of irrecoverable debt.